Let me ask you this. Have you ever felt like you missed out on a great investment opportunity? Maybe you've watched a stock skyrocket and thought, if only I had bought in earlier. Well, what if we told you that right now there are three promising companies whose stocks are essentially on sale? These aren't just any companies. They're innovative businesses with strong fundamentals and exciting growth prospects. And the best part, they're currently trading at steep discounts from their recent highs.
Global GDP today, all of global GDP today, is not much more than $100 trillion. And here we're telling you in the next 5 to 10 years, we're going to see up to 10 trillion in gross revenues, with the platform companies getting half of that. If the platform companies get half of that, 4 to 5 trillion, they're probably going to be worth somewhere in the 20 to 50 trillion dollar range. Now, that's just one example of convergence and generative AI combining to create an explosive growth opportunity.
Are you intrigued by the idea of buying high quality stocks at bargain prices? Do you want to learn how to spot potentially undervalued gems in the market? If so, you're in the right place. In the next few minutes, we're going to explore three such companies that have seen their stock prices decline between 35% and 65% from their 52-week highs, but still hold promising futures. Trust us, you won't want to miss this. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started and uncover these exciting investment opportunities together. Let's begin with Kura Sushi, ticker Cruise, a unique player in the restaurant industry. This innovative sushi chain has seen its stock price drop by about 35% recently, but there's more to this story than meets the eye. To spot a good buying zone for Kura Sushi, watch its 50-day and 200-day moving averages for signs of a bullish reversal. Also, check the relative strength index, RSI. If it dips below 30, the stock could be oversold, signaling a potential buy opportunity. Simple, yet effective. Kura Sushi, with 64 US locations, mostly in California, is poised for major growth. Management has big plans to expand to 290 locations, more than quadrupling its current size. But what really sets Kura Sushi apart? Think conveyor belt sushi, robot drink servers, and automatic dishwashers. It's like dining in the future. These tech innovations helped the company hit an impressive 20% operating margin last quarter. However, not everything is sushi and sunshine. Kura reported a $3.6 million net loss in the first 3 quarters, up from $1.4 million last year, mainly due to California's rising labor costs. But here's the twist. If the company can maintain its margins and control costs, the long-term potential is huge. Investors should look at Kura's operating margins and free cash flow to see if it can navigate growth without being overpriced. And with tech-driven efficiency, this sushi train might just roll into profitability. The recent dip in stock could be the perfect time to hop on board. Before we move on, quick question. In a market downturn, do you buy more of what you own or explore new sectors? Share your strategy in the comments below. We'd love to hear how you handle tough market conditions. Now, let's shift gears and explore our second featured company, Xmtr, ticker Xmtr. If you thought Kura Sushi was niche, Xmtr might just take the cake when it comes to specialized business models. Xmtr operates in the fascinating world of on-demand manufacturing. Imagine a digital marketplace where businesses needing custom parts can connect with small-scale manufacturers, offering services like 3D printing and CNC machining. That's essentially what Xmtr provides, acting as a crucial intermediary in the complex world of custom manufacturing. The stock is down 51% from its 52-week high, but this dip could present an opportunity. Watch for a MACD crossover, signaling a momentum shift. A bullish crossover might indicate a rebound, and tracking volume and price action can confirm if a reversal is underway. It could be the perfect time to jump in. For the upcoming third quarter, Xmtr is forecasting a more modest 14% to 16% revenue growth, slowing down from the 22% it saw in 2023. But don't let that deceleration fool you. There's more to the story. The company's active buyer base grew by 27% in the second quarter, now nearing 62,000 customers. Even better, the number of big spenders, those shelling out $50,000 plus a year, climbed by 24%, showing that larger companies are putting more trust in Xmtr for hefty orders. Xmtr's gross margin also saw a boost, hitting 33.5% in the third quarter, up from 31.7% last year. And this margin expansion suggests the company is becoming more efficient as it scales. Great news for long-term investors. With the stock price down over 50% from its highs, savvy investors might find this dip intriguing. And if you're into technicals like Bollinger Bands, a stock near its lower band could indicate it's oversold and primed for a comeback. Finally, let's turn our attention to Celsius Holdings, ticker CELH, a company that's been making waves in the energy drink market. Despite being down 65% from its 52-week high, Celsius stock has still delivered mind-boggling returns of 2,500% over the past 5 years. Talk about a roller coaster ride for investors. Celsius is expecting a bit of a slowdown in revenue growth, but even with that, it's still aiming for double-digit growth for the year. Now, in the first half of 2024, revenue jumped 29% compared to 2023, which is nothing to sneeze at. While growth may cool off a bit, it's key to keep an eye on Celsius's long-term fundamentals. The price to earnings, PE ratio, is a handy tool to see if the stock might be undervalued relative to its earnings potential. And if you're a fan of technicals, the RSI shows whether the stock is overbought or oversold. Celsius's low RSI could be flashing a buy signal. On the financial front, Celsius is cruising with no debt and plenty of cash on hand, plus operating income surging to $94 million in the second quarter of 2024 from $65 million the year prior. The company's growth engine is running strong. For the future, it's all about market share. And the more Celsius can grab, the brighter its long-term outlook will be. And if you're looking for a good entry point, using moving averages to track if the stock's trading below its average price could help you find a sweet spot. Given its strong growth trajectory, improving profitability, and robust balance sheet, Celsius stands out as perhaps the most compelling opportunity among our three featured stocks. While Kura Sushi and Xmtr offer intriguing potential, they come with a slightly higher degree of speculation. Celsius, on the other hand, has already proven its ability to disrupt a major market and generate substantial shareholder value. As we review the table, it's evident that each of these growth stocks presents a different financial picture. Kura Sushi, with a current price of $81.24, has a relatively small market capitalization at $914 million, but its gross margin of 12.97% suggests it's still working through profitability issues, as reflected by its negative EPS of negative 7 cents. Xmtr, priced at $18.30, shows a higher gross margin at 38.86%, yet its EPS is notably lower at negative $1.09, signaling the company's struggle to convert revenue growth into profits. On the other hand, Celsius Holdings, trading at $31.02, leads the pack with an impressive gross margin of 50.19%, solid revenue growth, and a positive EPS of $1.02, indicating it's in a much stronger financial position. These contrasting figures highlight the varying levels of risk and reward associated with each stock, emphasizing the need for thorough research to determine which one aligns best with your long-term investment strategy. As we wrap up our analysis, it's crucial to remember that investing carries risk, and while Kura Sushi, Xmtr, and Celsius each have potential, they also face unique challenges. Kura Sushi is revolutionizing dining with its tech-driven sushi model. Xmtr is reshaping manufacturing with its marketplace, and Celsius is leading the health-focused energy drink trend. Despite their stock price drops, these companies show promise for long-term growth, making them potential opportunities for patient investors willing to navigate short-term volatility. Successful investing means looking past immediate challenges to see the bigger picture. Companies with innovative models, strong fundamentals, and the potential to capitalize on market trends. Always consider your personal financial goals, risk tolerance, and how these stocks fit into your overall strategy. And before you go, here's a question to consider. Would you invest in a fast-growing company without profits, or a slow-growing one with steady profits? Let us know in the comments. If you found value in this analysis, please like and subscribe to our channel for more investment insights. This video is for informational purposes only and not financial advice. Consult a professional before making investment decisions. Thanks for watching Simple Investing Secrets. Happy investing.